Open a Roth IRA. Reason number 4, get to know IRMAA, IRMAA. IRMAA, my friends, is not your friends when not your friend when it comes to your taxes and retirement. Let me tell you right now, which is reason number 4 why you need to open a Roth IRA. So don't forget to subscribe if you like what you see here at the Heritage Wealth Planning YouTube channel. Look at that. Subscribe. And of course, comment, thumbs up, share the video. And I'm telling you, it's going to be crazy. So let's dive right into this, my friends. So we're going to go down. We're going to start with, I came across this guy's website, Jester Financial Technologies, Dan McGrath, and he writes some of the best stuff I've seen on the internet when it comes to financial planning and healthcare. I'm a huge fan of this guy's stuff. Don't know him from Adam. Looks like they got a pretty good software program, so I'm hoping to interview this guy to find out what their software does and whatnot, because I'll bring it to the masses if it looks good, because the stuff he writes about is fantastic. His blog is some of the best stuff out there for sure. So let's talk about what Dan writes, and I'll show you my spreadsheeting. That's always a fun thing for me to do. So this is back almost a year ago, but 2018 budget changes Medicare's IRMAA brackets. Doesn't get much more exciting than that, but I'm telling you, the lack of excitement is a way to get you to pay no attention, and then on the back end, you'll pay a lot in taxes. So with the Bipartisan Budget Act of 2018, there will be some new adjustments specifically for Medicare as the budget changes Medicare's IRMAA brackets. IRMAA is the income-related monthly adjustment amount starting 2019. The income-related monthly adjustment amount. Man, that doesn't mean anything, right? It's like an Ayn Rand novel here, some of this stuff that these guys say. So most people have no clue that IRMAA has anything to do with Medicare or your individual budget. IRMAA applies to people with higher incomes who are enrolled in Part B or covered under a Medicare Part D prescription drug plan. For those who enter Medicare's IRMAA, there will be a surcharge on top of their monthly Medicare Part B and D premiums. Note, Social Security benefits pay for these surcharges automatically. Also, once a retiree enters an IRMAA bracket, they are disqualified from the Hold Harmless Act, meaning there is a high probability that those who enter Medicare's IRMAA will see a reduction in their Social Security benefits. So hold harmless. If they raise Medicare Part B and Part D, it will not reduce your Social Security. That's what happens here. Not once you're in IRMAA. It will be a reduction in your benefits, because essentially how you're paying for your Medicare is via Social Security. So those earning $500, he's got $5 million or more of income will be in new IRMAA tax brackets. And I know everyone's like, oh, this doesn't affect me, but yes, it does. Here it is. Part B, under $85,000 of modified adjusted gross income. That's individual taxpayers. Your Medicare Part B premiums are $134. Your Medicare Part D, I'm saying $34. He actually says $53. I'm going with $34. I'm pretty comfortable with that. But either way, it's when I show you the spreadsheet, it's going to get you. $85,107. Again, modified adjusted gross income is all your income, which is in this case what I'll use is 85% of your taxable of your Social Security benefits will be part of your MAGI. Plus your tax exempt, and that's before you take your standard deduction or itemized deductions. All right, so $85,107 Maggie or Maggie, however you want to say it. Your premium is another, it's at 52 above, so basically 30. I think it's a 28% increase on your monthly premium, and then your Part B is another 28% increase. 103 to 133, your premiums double. All right, so and I'll go into this a little bit more detail when I show you the spreadsheet. But just remember, your modified adjusted gross income, I'm going to use 85% of your Social Security benefit plus your required minimum distribution. And I'll show you how quickly and easily you can get to that bracket as well. We're going to pay surcharges, and you will no longer be subject to the hold harmless provision of the Medicare premiums. And this is important here. I'm telling you, this right here is the number one thing. Medicare Board of Trustees, as of 2017, is reporting that the premiums will remain constant through 2019, but will inflate at a rate of 5% for Part B and 7% for Part D each year through 2026. And then who knows what it's going to be. The CPI for urban consumers, the clerical CPI, urban consumers, CPI-U, will be used starting in 2028 to determine the income brackets for Medicare's IRMAA. So right now they're using the CPI for urban clerical workers, CPI UW, I think is what it's called. But that'll be for Social Security adjustments, and they're going to start using the similar thing for their CPI-U for urban consumers, not workers, clerical workers so much. Be interesting to see how that shakes out. In fact, if I think it probably, who knows? But they'll start using that in 2028. Starting in 2028, each August, there will be a 2-year look back to determine the inflation rate for the upcoming year, i.e. Medicare's IRMAA surcharges and brackets according to the CPI-U data. If the CPI-U increases, the IRMAA brackets will adjust to that year's rate of inflation. There are also numerous changes to the overall Medicare program, although from an investor's perspective, when their Social Security benefits and the costs associated to the healthcare coverage are on the line, these are the biggest. So I'm going to revisit back with Dan. He's got some other articles I want to talk about because I love his stuff, and you should subscribe to their blog for sure. I know he's got a basketball thing up there, and that's interesting. All right, so let's go down to this table I was using. I know there's a lot going on here, but this was a table I was using the other day when I talked about you're 50 years old and $250,000 in your IRA. Look out, the tax man cometh. All right, so we're going to use the same thing, but I'm adding data for IRMAA for Part B and Part D as well. All right, so in this case, again, we're 70 years old. So in this case, we start at 50 years old. We have $250,000 in our 401k. We're getting a 7% rate of return. We're adding $6,000 a year until we're 60. At 60, we stop. We're not tapping into it. And then when we hit 70, we got $1.13 million in our IRA/401k. All right, so we take the $1.13 million. We divide by 27.4, and our required minimum distribution amount in that year is $41,000. Take 1.13, subtract your RMD. That gives you your the value that you start the year essentially of $1.08 million. We have a rate of return of 7% in the following year. Our end of year value is $1.16 million. Divide that by 26.5, and you can see in our RMD is $43,980. You can see how this goes. All right. So what we're doing. We had 66. We had Social Security at $2,500 a month, or let me see. I'll see if I can make this a little bit big. I'll make this bigger here in just a second. But we have $2,500 a month. We're inflating that each and every year at a 2.6% rate of inflation, which is essentially what the trustees say is what they expect for Social Security cost of living adjustment. So $30,000 a year at 66 will be $33,243 at 70. All right, our IRMAA bracket, and again, our IRMAA, going back to what our man Dan shows us here, is 85 to 107. That is in 2019 IRMAA bracket. So if you have over 85,000 but less than 107, you have a IRMAA surcharge. But those IRMAA brackets, we're going to inflate those because those do change. Now, initially, they weren't going to change. They were going to be indexed, not indexed at all. I think it was under ACA, Obamacare, the Affordable Care Act, if I'm not mistaken. Yeah, I'm almost positive that's the case. And then the Bipartisan Budget Act changed that, thankfully. But at the end of the day, they weren't going to be indexed for inflation like Social Security and like net investment income tax, but they've changed that. So IRMAA tax brackets, I'm going to adjust at 2.6 percent a year as well, just to equate with Social Security because they're going to use presumably the same index, the CPI-U, urban consumer, those consumer price index for urban consumer CPI-U. So Social Security is growing at 2.6, as is the tax brackets or the brackets for IRMAA surcharge are growing at 2.6. So if it's 85,000 in 2019, it'll be 94,000 when you're 70 years old. All right, hope that makes sense. All right. Now, Part B and Part D, I'm inflating these at 6%. I'm basically taking the average. The Medicare trustee says we're going to inflate Part B by, I think it's 5.7, and Part D by 7%. I'm just splitting the difference, saying roughly 6% a year. So essentially what I'm doing here, Part B and Part D, I got $134 a month when I'm 66 years old for Medicare Part B. I got $34 a month for Medicare Part D when I'm 66 years old. I'm inflating that, and which cost me $2,000 a year. By the time I'm 70, Part B and Part D will cost me $2,455 a year. Each and every year, that will be inflated at 6%. All right. So far, so good. our AGI, what we're doing with just simplicity, we're taking 85% of our Social Security benefits. Now, in the first couple of years, you're probably going to be a little bit below 85%. You can do the provisional income numbers. I just don't feel like it's just not that, it's not worth it for a couple of years to do that. But these numbers aren't, in fact, none of these numbers are going to make any sense at all to anybody, simply because everything is going to change. We're just predicting based on current numbers. You're not going to get 7% a year. You might get 6 point, who knows? But this will give you some thought process to adjust your plan. So essentially what I'm doing is I'm saying 85% of our Social Security balance will be added in our AGI, adjusted gross income, or we can even call it modified gross income. Don't care. Either way, it's before standard deductions or itemized deductions. All right, so 85% of that plus our full RMD. All right, so 85% of Social Security plus our full RMD is going to make us, that's going to be our AGI. All right, so 85%, 85% plus our RMD. There you go. All right, so essentially what's happening here is we're saying, let's see, C3. Yeah, that's right. G3, make sure it looks, yeah. All right, so good. So we're saying this is going to be our AGI, if that makes any sense. All right, so now what we do is we say 69,000 subtract from the $94,000 tax bracket for which is IRMAA. Then I don't have any surplus, so I'm not in the surcharge because I have a positive balance here. All right, so let's make that a little bit bigger here. All right, hold on, just all right, so oops, I forgot to make it bigger. All right, let me make this a little bit bigger here so you can see the numbers a little bit better. Let's make that 125. All right, so basically what we're doing again is we're taking 85% of our Social Security and we're taking 100% of our RMD. That gives us 69,000. We subtract 94,190 minus 69,000, and we have a surplus of 24,675 before we get into the IRMAA surcharge. And we keep doing that each and every year until we get here, which is when we are, let me move my big mug out of the way. 15 point, I didn't put the age, did I? Nope. So let me go to my other screen. 15.5 is when we're 84 years old. So when we are 84 years old, which is this right here, again, this is for single payers, we're going to be in the IRMAA surcharge, and we'll have to pay an extra, what was it again? It's right now it's an extra 29%. Let's just say simplicity, 30% on Medicare Part B and Part D. All right, so we keep going down. What happens here? Right about there, about 14,960. Not quite. So in this scenario, we never break the next threshold where our IRMAA premiums double. I don't think 14. No, they don't. Okay, good. So in this scenario, the only thing is we have IRMAA surcharges at 84, 85, 86, 87, 88, 89, 90, 91, 92, 93, and we basically have to the rest of our life or until we're, 98 years old. So basically we are paying IRMAA surcharges in that scenario from 84 till the rest of our life. And again, the IRMAA surcharges is a 30% increase on your Part B and Part D. We don't know if Medigap is going to have that increase or not. I just don't know. And Medicare Advantage, we just don't know. But either way, you can have an increase on your Part B and Part D for sure. All right. And that's even adjusting the IRMAA tax brackets. All right. So what happens if we have some other income? I don't know. So you got $15,000 a year of tax exempt interest. Oops. I don't want to do that. Let's bear with me just a second. Cancel out that. Boink. There we go. So here we got $15,000 a year of tax exempt interest. Let's just say that. All right. Now what happens? All right. So now we have $85,000 as our AGI because we take 85% of our Social Security plus the tax exempt interest plus our RMD. And now at the ripe young age of 22.9, which is the age of 75, we are in the IRMAA surcharge, and we will lose Social Security benefits to the extent of that's $50, $53 a month right there alone. Actually, that's even before your Part B kicks in. So that's about $90 a month we're going to lose in Social Security because it's no longer a hold harmless. But it only gets worse. So now I'm saying our tax exempt, it does not matter what kind of income this is. It'd be a pension, tax exempt, it does not matter. But I'm saying this is growing at a 4% clip. We can do whatever we want. Let's say it's dividends. It literally does not matter. But I'm saying your other sources of income is growing at a 4% clip. watch what happens here. So now we're, what did I say, 78 years old or something? No, 75. We have, I tell you what, let's do this. This will make it easier. Yeah, this will be better. Let's put that right there. And we'll just do it. I'll do it all the way to 103. And copy. Blink. And we'll do it from right. That should work for us, I'm thinking. Yeah, all right, sweet. So here at 75 years old, we are in the IRMAA surcharge, all right? But it gets worse, my friends. Right there at 83 years old, we're not only in the IRMAA surcharge, but we're in the IRMAA double surcharge. So here, our Social Security is going to go up by $267 and then another 34. So it's going to basically $300 a month. We're going to lose the Social Security right there because we're in the second tier of the IRMAA threshold. Because once you break 107 minus 22,000, once you're 22,000 above the IRMAA surcharge, or knee deep in the IRMAA surcharge, you're not just getting a 30% surcharge, you're getting a 100% surcharge, right? And so the next one, we got to wait another 107. And I'm looking at my paper here. You all can't see that, but I'm just looking at the rates on the various surcharges on IRMAA. 133 minus 107. So now 133 minus 85, bear with me, 48,000. So if we ever hit the 48,000 in this negative area, which again means we're in the IRMAA surcharge, that simply means we're going to have triple of Medicare Part B and Part D. So let's see if we ever break 48,000. And yes, we do when we're 91 years old. And I can almost assure you, if you think that's the lowest going to get, you're wrong, because the Medicare is hurting much, much worse than Social Security. We got some pretty significant radicals running for Congress or running for president who are talking about essentially confiscating of high income people and high incomes, whatever they choose. And so if you think that these IRMAA tax brackets might not change, I highly suggest you think again, because this is, for high income earners, they're going to find money for Medicare. There's no other way around that. So again, now we're in the IRMAA threshold of having our IRMAA premiums double or triple. And again, IRMAA is just a surcharge for Medicare Part B and Part D. And again, if you think Medigap is going to be free of this, I would tell you to think again. And so now we're paying, we're going to lose $400 a month from our Social Security benefit right there. All right. And that's, again, not even adjusting it with inflation. That's just saying that's just saying in today's numbers, you're going to lose the equivalent of $400 a month. Basically, you'll lose, what's that? If we're getting on Social Security $2,500 a month, you'll lose 400 divided by 2,500. You'll lose 16% of your Social Security benefit right there. All right. So now if it gets above 160 minus 85, if it gets above 75,000, okay, it never does. So if it gets above 75,000 above the initial IRMAA surcharge, it'll be a quadrupling. All right. So that gets pretty bad. All right. So let's just say you got a pension of $30,000 a year, and we'll say, we can do whatever we want here. We'll say you got a pension of $30,000, it's $20,000 a month, $2,500 a month. But instead of 4%, we'll just say it gives you a 2%, I'll say a 3% cost of living adjustment. Again, we can do whatever we want here. All right, so you got a pension of $30,000 a year with I got to do this. Boink. We got to go down here. Instead of 4%, we're going to get 3% cost of living. And let's see what we got here for IRMAA. And you're already in IRMAA at 70 years old. So here we got a pension of $30,000 a year. We got required minimum distributions of $41,000 a year, and we got Social Security of $30,000 a year. So $2,500 from Social Security, $2,500 from your pension, and $41,000 from your IRA RMDs. And you're already in the IRMAA surcharge, so you are immediately losing 30% of your Social Security benefit, but not 30% of your Social Security benefit. Excuse me. You are losing. You're paying 30% more in Medicare Part B and Part D, which is coming directly out of your Social Security benefit. So you are losing, it's going to be 57, almost $100 a month in your Social Security benefit. It keeps scrolling down. And now right here, we're paying into the doubling of the IRMAA surcharge for sure. Keep going down. And we have 51,000. We're tripling. And do we ever break 75. Yeah, so now we're quadrupling. So now we're 93 years old and we're quadrupling our IRMAA surcharge. And that's just assuming the IRMAA tax bracket is adjusted with inflation. Again, under the initial Obamacare, I think it was Obamacare, I'm almost positive it was, the IRMAA brackets did not adjust with inflation. They were not indexed, similar to how Social Security is taxed. Thus, what do? Well, I tell you, it's simple. You don't have IRAs once you hit retirement. If you have a pension and a decent Social Security income, you got to be looking at IRAs, simply Roth IRAs, simply because the IRMAA is going to eat your Medicare premiums alive. And if you think this is it for copay and coinsurance and Medicare Advantage or Medicare Supplement, I'm telling you, according to the government, you will be rich if you're making the equivalent of $2,500 a month in a pension, $2,500 a month in Social Security, and was that $3,500 a month in your IRA required minimum distributions. So reason number 4 to have a Roth, get to know IRMAA. IRMAA is not your friend. It's never going away. It's just never going to go away. If anything, it's going to get worse. As always, if you like what you see, subscribe. If you're getting value out of this and you want to donate to the old Josh, go to my blog at Heritage Wealth Planning. On the bottom of every page, on the bottom right, you'll see a tab that says donate or a little button that says donate. I'm a capitalist, so if you're finding value of that and you want to reward that value, send me some money. I'd be happily appreciative of that. You can always go to heritagewealthplanning.com also to buy the books on the tax bomb in your retirement account. My book I have on this, which is right here. I think it's $4.99 on the Kindle. Kindle Unlimited is free, $4.99 or $4.49 for the Kindle download, and I think it's I can't remember how much it costs to ship. But as always, you like what you see, and lastly, subscribe and comment and share the video. We'll see you next time. Thanks, guys.